Today, it gives me a great deal of pleasure to introduce our first of two speakers today from Canada Life. Our first speaker is Clarke Hayens, the Regional Sales Manager of Wealth. Clarke has been with Canada Life for the past 7 years as a wealth wholesaler, originally in Vancouver and now based for the last 5 years in beautiful Kelowna, BC. Prior to Canada Life, Clarke was a financial planning-based advisor with a credit union, working primarily with mutual funds and segregated funds in his practice. Clarke is our dedicated wealth rep, working with advisors associated with IDC World Source and covers all of BC. For advisors on the call today in other regions, please reach out to either Clarke or myself or Graham, and we can introduce you to your local wealth team. Clarke is very passionate about working with wealth solutions, and he feels very strongly about the added value which a wealth wholesaler can bring to your business. Clarke has a degree in business and has also attained his QAFP, CIM, EPC, and RRC designations. So very well qualified to assist you. Today, Clarke is going to cover Canada Life's very exclusive and industry-leading estate protection series, and also touch upon some of the wealth platform enhancements at Canada Life. When he's finished, Clarke will pass it over to Canada Life's private wealth counselor, Kelvin Wong, and we'll make the formal introduction then. I will monitor as well some of the Q&A. Any questions, please use the Q&A and not the chat, and we'll handle these at the end of the webinar, and then we'll be back. I'll be back to close the session. So once again, welcome. Thank you for joining us today. Thank you for your business. And Clarke, over to you. Take it away.
Thanks, Alex. That introduction makes me feel pretty old, actually. So I just want to make sure my screen is being shared properly. I'm hoping everything is okay there.
Yeah, it's looking great.
Perfect. So yeah, thanks for that introduction, Alex. I am going to walk through our estate protection series. I think that it may be a review for some of you out there today. It might be new as well for some of you out there. It's such a fantastic planning strategy, estate planning strategy for clients that are age 80 to 91. Like Alex said, industry leading. A day doesn't really go by, a day or two for me at least, that I don't get connected with to talk about estate planning, estate protection series with us. Hey, Clarke, I have a client that's 83. I need some help. So after that, I will move into talk briefly about some of the wealth platform enhancements that we've added in the past several months. So let's get into it. I'm going to set the stage quickly here just about the need for estate planning out there in Canada today. I think everybody is aware of it. Retirees age 80 to 90, they represent a growing target market for intergenerational wealth transfer. I love that buzzword, intergenerational wealth transfer. These clients tend to have more accumulated wealth than previous generations. They need solutions then so they can structure their estate so they can be transferred to the next generation and in a tax efficient manner. That's also big. Some of these clients, they might find today's financial opportunities and choices hard to understand, and they need advice from somebody that they can trust. So that's where everybody on this call today comes into the picture. They value their hard-earned savings as well, and they want to put it to work for them for whatever their goals are. So this slide shows a summary, certainly not exhaustive summary, of the sorts of things that are on the minds of elderly Canadians. They could be overwhelmed with estate planning, difficulty in understanding the complexity of settling their estate. Some may find it super important to keep their capital and not be so tuned into, I want to get 10 or 12% as a rate of return. They want to control who their money is distributed to, and also how it's distributed to on their passing. This is a big one that I think, at least I didn't realize this when I first came across it, but I think sometimes there's an overly optimistic feeling out there amongst families that the kids are going to get along at the time of estate distribution. And maybe this isn't the case. So lots of things going on in the mind of elderly Canadians. Certainly when we, as an individual, reach this age, mental capacity is a massive concern for this group. I can actually speak personally to this. I have an 83-year-old dad, and he's recently taken a downturn pretty severely with his health, and dementia is starting to come into play. So I think if you haven't personally experienced dementia before, we have clients out there that are going through that. They may not want to talk about it. So these are the sorts of questions that we need to ask our clients. This individual, he or she with dementia, very challenging when it comes to financial decisions. They're going to struggle with these. Often people with dementia can continue with day-to-day finances, such as paying for shopping, but complex decisions become a lot more challenging. So we know that advisors care about your clients' lives, and watching somebody with dementia go through it, again, I can speak personally here, it's just so challenging. So 51%, this slide talks about a Angus Reid Institute survey. 51% of people never get around to writing a will, and they're not aware of the consequences of passing away without one. I think 51%, that's a massive number. Without estate planning or without a will, clients could definitely lose control over how and to whom their assets are distributed to at their death. Very important. So I mentioned intergenerational wealth transfer. It's a massive opportunity that's going to happen over the next, call it, 7, 8, 9, 10 years. Could be 1.2 trillion in assets that's going to be transferred between households. So there's such a great opportunity right now for advisors across the country and the industry to be proactive about these wealth transfers and provide clients with guidance that they need. So this slide looks a little bit about who's going to inherit. Generation X, young baby boomers. I think the key is there's going to be individuals across different age groups inheriting. And I think that advisors who are proactive in having those conversations with clients are going to do very well, especially when it comes to securing the assets at distribution. A big conversation is, well, I have mom and dad's money, but I don't have the children's accounts, and I don't want to lose that money. So a great way to put a fence around that specific situation is with our estate protection series. So like I said, we are super competitive advantage in this space. I see it all the time. It's a great conversation to have with clients because you can sit there and talk about guarantees, 100% death benefit guarantee, with clients that are age 80 to 91. It's such an easy conversation. And then you can talk about, well, we don't necessarily have to use a term deposit or a GIC based strategy. We can put it into the market in something that over time should still grow your money at a better rate of return than call it GICs would. So our estate protection series segregated fund policy helps clients pass on their legacy to their beneficiaries securely with built-in guarantees, potential growth and flexibility for your client's investment portfolio. So this slide it's a summary, I like to say, of our estate protection series. 100% death benefit guarantee, customized inheritance, settlement election form, is what we use at Canada Life on non-registered policies. We can see their curated fund shelf. And that's a big one at Canada Life because, and I'll allude to it a little deeper into the session here, but we've really changed and improved our segregated fund platform in the past 2 to 3 years. And some of those mandates that we've recently added, such as Bootel Goodman's Balanced Fund, is on our estate protection series platform. You don't need a ton of money to go into estate protection series. The minimum initial premium is 10 grand. Big one is estate bypass. You don't have to take forever to settle the estate. You don't have to pay the estate dollars. If it's BC, I think it's 1.4%. So I think most individuals that are in that age bracket, they want to give as much money as they can to their intended beneficiaries and as little as they can to the governments, right? So we do have a joint annuitants feature as well. So it gives clients greater control over their estate planning. It's tailored to their needs without the costs of setting up a trust, which is huge. Decisions can be made up front when the annuitants are mentally well and confident in their decision making. So customized inheritance is also a part of our estate protection series. The policyholders could choose and decide how they want each beneficiary to receive their inheritance, whether it's a monthly income for life. It could be a lump sum. It could be a monthly income over a set period of years, or it could be a combination of all these three options. So it's very flexible. I've seen advisors use this extremely successfully with their estate planning strategies with clients in that age bracket. Our estate protection series is not a locked-in investment. Clients do have access to their funds. So it is a front-end load, 0% charge setup only. So if clients do come across unexpected times that they need access to their money, they can certainly go in and withdraw from their estate protection series policy. Any withdrawals are, of course, taken away from the amount that's guaranteed. Clients can also add to their estate protection series policy at any time. You can actually add to the estate protection series contract up until the day the client turns 91. I've actually had advisors reach out to me and are like, hey, my client's 80 years old, 8 months. When can I make the last deposit? And that last deposit is 100% death benefit guaranteed, which is massive for sure. So here's how the death benefit guarantee works. I think most of us can understand that if there is a dip in the markets and timing does dictate that at passing, the market value is worth less than the principal investment minus any redemptions, Canada Life will boost the value back up to 100% of principal investment. Again, a very easy conversation to have with clients. Now, the next couple of slides speak to market volatility and also estate costs. So 100% death benefit guarantee in action with market volatility. Well, if we are invested in mutual funds, guess what? If the market drops and the individual passes away, well, that's too bad. Your account is only worth 1.35. At Canada Life with the estate protection series, you're paying a little bit more for this, but I think clients in this age range do understand the value that's provided. You'll get back your initial investment. Again, an easy conversation with clients. Market corrections happen a lot. We've gone through one recently, however many months you want to back that up, but market events happen a lot. And to be able to sit across from your client and talk about 100% death benefit guarantee, talk about estate planning upfront, you can disperse the funds however you want to your intended beneficiaries. It's a great conversation, really good conversation to have. So here is a slide that does show which of our specific funds are on our estate protection series platform. So it certainly is not our full segregated fund shelf. We do have funds up to balanced investment space. We have our TD Greystone balanced fund on here, Canadian neutral balanced. I alluded to Bootel Goodman's balanced fund is in this on the estate protection series platform as well. Mackenzie's Canadian fixed income balanced fund is in here. So there are excellent balanced fund choices that are on this platform. Reason being we don't have anything higher equity than balance is I think most clients that are in this age range, like I said, they're not looking to shoot the lights out with rates of return. So balance is a good kind of middle of the road option for these clients. So this is a very good snapshot. If we need to talk with clients about, hey, what about market-based versus a GIC? And lots of information on this slide. I'm not going to go into it because we are time restricted here. But this is something that we can put together at Canada Life, a show and tell, if we need to have that conversation with clients of something that's market-based that should grow better over time than a GIC. I remember when I was an advisor, I had pressure on me to get money into market-based investments. And I use these all the time with clients, and they worked great. So again, benefit to clients, maturity guarantees to help protect against negative market swings, privacy of settlement terms, that's a big one as well. Name beneficiaries. It's a great product. I can't flog it as a wholesaler any more than I already tried to. So this slide talks about potential costs for non-reg assets. It talks about estate costs. At the end of the day, in a nutshell, estate protection series, you're going to pay less than if we were walking through settling estate. Whatever percentage the province, in that province, you have to pay estate fees by. Now, very quickly, I do get asked, well, hey, Clarke, how much more is it for estate protection series versus mutual fund? And it's a great question. This slide shows black and white what the difference is of a mutual fund versus a segregated fund on our platform. Balanced fund versus balanced fund on the segregated fund on the estate protection series platform. So it's about, give or take, 35 to 40 basis points difference. Now, some clients may not see the value in paying for that because certainly the fee conversation is super prevalent. I think most will when you have all the client benefits that this strategy provides. Again, bypassing probate, market downturn, again, 100% death benefit guarantee versus something that isn't. It's such a strong conversation. This slide talks about the same thing. Lots of support. We at Canada Life do have a lot of, we have the advisor guide, we have the client guide. Anything you need that you think will help your conversation around estate protection series, certainly reach out to Alex or your Canada Life wholesaler or whoever your IDC contact on the wealth side is. We have what you need. So talk to your wholesalers. We'd love to talk to you about estate protection series. So I got a few minutes left here, and I'm going to speed through some of our recent wealth shelf enhancements because I think it's a good conversation to get out there into the industry. Performance is the first one. The Fund Data Fund Grade A+ awards were recently handed out, I think a week or so ago. And this is big business, a big thing in the Canadian investment funds industry, given annually to investment funds and managers who show consistent, outstanding, and risk-adjusted performance throughout the year. Here's our list of funds that have been recognized in 2021 and 2022. We've actually had, call it 6 funds on our SEG fund platform that have been recognized for 3 years in a row. Our US mid-cap growth, our Canadian small cap growth, our global growth opportunities fund by Mackenzie, Canadian neutral balanced by TD Greystone, which is on our estate protection series platform. So I think the proof is in the pudding here. Our, like I said, our SEG fund platform is really starting to get recognized out there. We have terrific investment fund managers on our platform now. We have niche managers that are not on other suppliers' platforms like Aristotle in the US equity space, or North Cape. We have JP Morgan on our international platform. So we have a wide array of investment managers across our platform now to choose from for whatever your client needs end up being. Strong performance. Yeah, again, our SEG fund shelf ranks 2nd in the industry for the 1-year period, with 65 of our funds performing above median. 85% of our AUM is also above median. So again, the risk, the performance is black and white when it comes to our funds being recognized. This slide is really a summary of a chargeback promotion that we've had out since the end of October. So you may have heard about it, you may not have heard about it. We've sent a lot of corporate emails about it. What it is for our chargeback series until April 24th of this year, we are paying 4% upfront commission. Our usual is 3%. Now there is a lot of chatter out there about, and I get asked a lot, you know, hey, Clarke, is chargeback series going to go away like DSC is? And I think there's a lot of anxious advisors out there. So the kind of update with that is there really isn't any update. The regulators are certainly on DSC. I think the key is what the verbiage regulators have used is upfront commission, and that's certainly what chargeback is. So Canada Life, we decided to up the ante until April, and the decision date on if chargeback's going to go away with DSC is in June. So this is real. I think all the suppliers are kind of waiting to see what's going to happen, and that's certainly why our promotion is only going until the end of April. This is a good slide. If you want it, reach out to me or reach out to Alex. It's a comparison of the current chargeback commission rates out there amongst the different suppliers. Ours is topping out at the highest cumulative gross commission for invested money of 4 years and also of 8 years. So if you want this slide as proof in the pudding, certainly reach out to myself or to Alex. Now, I'm going to skip down and I want to throw this up on the screen as kind of a closer for me here. So a couple months ago, we did launch our index ETF portfolios to the market. I think most all suppliers are playing in this space now. So our product team at Canada Life came together and decided, hey, let's get into this space as well, because it is, you know, low cost, all-in-one diversified portfolios is what we are offering. Simple, cost-effective solution with the added protection that a segregated fund policy offers. So here are our 3 ETF portfolios. You know, I actually like that there's only 3: conservative, conservative, balance, and growth. So, you know, there's not 5 or 6 that you need to wrap your head around. You know, if you're into a conversation with your client and we're conservative, well, here you go. Balanced, a little more equity, here you go. If we're higher equity, we do cover that with our growth portfolio as well. These have been super popular with advisors since we launched them. I encourage everybody on the call today, if you haven't heard about these yet or talked about them with your wealth wholesaler from Canada Life, please reach out to whoever that is across the country. My last topic here is our asset allocation funds. And this is an interesting one to me because our seg fund platform has had asset allocation funds on it forever. They've been on our estate protection series platform forever. And traditionally, these funds have protected the downside very well. Some may argue gave up some upside participation, maybe because of the geography composition. So I want to say 18 months ago, again, our product team came together and kind of said, hey, we need to make some changes to these asset allocation funds to make sure that they stay industry competitive going forward. And that's exactly what happened. The change that I really liked was the decrease of Canadian content and the increase of global content. That has helped immensely, for sure. And we've also added the ability to expand the individual underlying funds that make up the asset allocation wrap. So that has also helped immensely. This slide, a brief summary of some of the enhancements to PSG strategies over the past couple of years. And again, the proof is in the pudding with the asset allocation funds performance. I'm not going to read off the tidbits here. We can look at the slides, but I think the results that we've seen with our asset allocation funds, due to the changes, the tilts that PSG has done over the past, call it year and a half, have been phenomenal. And these are available in our estate protection series platform, conservative, moderate, and balanced. So again, if you want to talk more about these or anything that I've briefed today on this session, reach out to your Canada Life wholesaler. So that is it for me. And I am going to now introduce one of our director private wealth at Canada Life. His name is Kelvin Wong. And Kelvin's going to walk everybody through our high net worth series offering at Canada Life. So thank you for your attention, everybody. And I'm now going to pass it over to Kelvin.
Good afternoon, good morning, everyone. My name is Kelvin Wong. I am working closely with Clarke in Toronto here, stationed in Toronto here. My role is Director of Private Wealth in Canada Life, helping on the high net worth cases. Been working in the company, probably in the industry for the last 20 years. The first 5 years I started in the bank as a financial planner, and then 5 years working in a private insurance investment company as a sales director. And for the last 10 years, I joined Canada Life, especially focused on the high net worth clientele on the wealth business. So today, I want to share with you 3 key topics that definitely draw your interest or help your business. First is what Canada Life Private Wealth Services means to you. Second, we're going to touch base a little bit for the market outlook. We have a phenomenal January 2023, but was that going to be all nice and good looking for the rest of the 11 months, or what's going to happen? We're going to share you with our insight. And last but not the least is going to share with you when you need to build a model portfolio with the Canada Life funds, how we can help you from our sales team or sales support. So first and foremost, 2012 is where we starting 10 years ago. We started our Preferred Series program. Preferred Series program basically is if the clients have over $500,000 of aggregated assets with Canada Life, which including segregated funds or even GIO, daily interest account, or annuity, as long as it's over $500,000, your segregated funds investment will have a lower MDR, lower fees. This is what we call the Preferred Series program. And rule of thumb is roughly around 15 to 20% discount compared to the retail funds. but really depending on if this is a balanced funds or equity funds. So if you look at right in the middle, we call it preferred series one. It's a traditional, what we call a bundle series. If the MER of a retail series of a fund, a balanced fund is, let's say, 2.25%. The preferred series one might be 1.9%. It's the same fund. Everything is just like the regular MER. Or on the right-hand side, you're going to see that you have the preferred partner series or the preferred series two. That is the fee-based structures. This is something that I see a lot of clients, advisors tell me, say, Kelvin, I've been running the business for the last 20 years. I'm using the bundle series. Why I'm going to use it fee-based? To my understanding, to my view, is not really your choice. It's actually when the client's actually dealing with a lot of the bank, that the brokerage firm, they're already doing fee-based business. What our company or what Canada Life try to do is providing you fee-based options that you can able to offer the same or similar fee structure service compared to what our competitor do. So beside the fee base or beside the lower fees, this is more than just the fee. High net worth offering for Canada Life, beside the fee structures, we also have the tax advice from or tax help from our directors, tax and estate planning. Some of you might met John Yankas before. He's our chartered accountant based in London and covering on the wealth side to help you if you have a lot of questions about taxations on the investment structures. So that is something that we can add on to your high net worth service. And then myself, Director of Private Wealth, we have two of us across the country. I cover Toronto as well as Western Canada. And my counterpart is based in Quebec, cover, of course, Quebec and Atlantic Canada. So what we do or how we can help you on your business, besides just the price, first and foremost, we have launched the customized investment proposal. That is something that I find is very neat. When you have a high net worth case, when you have some, I always say that, you know what, you have an opportunity to see clients that have $1 million. They're not having just $1 million sitting in bank waiting for you to come to take the business. A lot of time they need you to, okay, you know what, give me a proposal, give me something that let me take a look at it. So the investment proposal is something that we help you gather with the cover page that have your information, your client's information. And then when you provide me the details, we're able to provide all the information listed inside the proposal. What is your current investment looks like? Why we suggest what we suggest, and what will be the fee structure looks like. That will be in one, like a 20-odd pages proposal that you can present it to the clients. Beside the investment proposal, something that I really like to offer as well is a portfolio summary of the recommendations. A lot of time, if we're going to giving clients a 4 or 5 funds recommendations, chances you're going to give them a 5 fund fact. And but to me, when I look at it, is what we can help you. You know what? If I'm going to put 10% in here, 20% in here, what will the overall picture looks like? We're going to provide you a portfolio summary with what our suggested portfolio looks like and how we compare to our peer group. How we compare for the last few years, especially last year's when the market was down. How we doing on the performance? How we protecting clients' money? So those are the one that I call the portfolio summary report. That's one out of the 3 reports I like to share with my advisors. Second is, besides just our recommendations, clients probably have some existing money with the brokerage firm. They might be in a stock portfolio. They might be in a mutual funds portfolio. Bring it to me. Bring the statement to me. We can do a head-to-head comparison just to try to help you to looking at, okay, the clients might have too much Canadian right now, or might be too much stocks holding right now. They are at age of 80. We might be thinking of using estate protections, bypass probates, but can we have something to compare with what they do, what they already invested? So this is something that we, Clarke and myself, will work together to present the proposal report to you. Last but not the least, we also do we call the income illustrations, hypothetical income projections. So something that if the clients have, they say, Kelvin, I have $1 million. I want to take out $50,000 for retirement. Will my money die before I die? So when we run in some illustrations on it with using the real data, what happened in 2021, what happened in 2008 with the up and down market, we're going to using this data to help you just giving illustration to see that if the money invested 20 years ago When we're starting in 2001, we're seeing the technology bubble, we're seeing the financial crisis, we're seeing what happened last year with the huge inflation hike. Will my money still survive? So those are the things that we able to help you to add on to present to you so you can share with the clients to close business. So that is something that from a Canada Life company, what we call the high net worth offering, beside just the lower the price, lower the end yield. So second part is we talk about market outlook. I'm sure that you probably hear a lot from multiple companies. And Canada Life, probably 3 weeks ago, we sent out the Market Outlook 2023. And this is something that I always like to share with my advisors because as of you may aware that Canada Life, we don't have any more internal money managers. Last couple of years, we sold GLC to McKinsey. So as Canada Life Investment Management itself right now, we are a coach. We're looking at the players in the market to see how we can fit it in our shelf to provide you with multiple different selections. So this market outlook, something I like is it has collectively getting the information from 14 different money managers around the world. I want to hear the view, not just from a Canadian manager, not just from a US manager. I want to also hear the view from a European manager. A guide from a money manager from Copenhagen probably have a different view than a person in New York looking in the same world, looking at the same stocks, looking in the same area. Because with a different perspective, this is where we can help and diversify the portfolio. So by saying that, this is what it looks like from a fixed income perspective. We all know last year, in the beginning of the year, I recall that we have a 3 months T-bills. Probably is only 0.2%, 0.4%. It was the interest rate. And then by the end of this year, in the beginning of this year, January 2023, beginning of this year, the T-bill is 4.2%. It rolled up by almost 4%. The interest rate spike last year was hurting a lot of the fixed income. And this is what the outlooks like last year's. When in the beginning of last year's, you're seeing that fixed income we consider as 3 different categories. The government bonds, the sovereign bonds, the investment grade corporate bonds, and of course we have the high yield corporate bonds, which is of course is not as high quality, high credit ratings. That's why they pay high yields. And last year, because of the low interest rate environment, we've been underweighted the corporate bonds, we've been underweighted the government bonds, and then we've been overweighted the high yield bonds. But in the beginning of this year, if you look back to all the interest rate right now, 4 different fund managers on the fixed income side have agreed and also looking at it and saying, you know what, this year, a regular 10-year government bond is hitting almost 3%, or some of them is 3.5%, depends on which country they offer. High quality government bonds already have such a high yield. Why take a risk into the high yield corporate bonds? So that's why they're increasing their the outlook from underweighted to neutral on the government bonds, overweighted the investment corporate bonds, and underweighted or go back to neutral on the high yield corporate bonds. But all in all, this year you're going to be expecting with a decent yields coming back in place in the fixed income side. When the market volatile, equity side, the fixed income, the bond market, were able to protecting the investment portfolio, just like what it's supposed to do. So that is the fixed income views according to the government bonds, corporate bonds, as well as the high yield. How about the equity side? On the equity side, the looks are a little bit different this year. So lots of fund managers have been debating, and it come with a sort of a summary right now here is for the Canadian sectors, it recommended to overweight the Canadian equity sectors versus the south of the border, the US equity will be underweighted this year. And international and emerging markets will be overweighted as well. So we're going to be go through each sector, each geographic regions one by one, just to give you my 2 cents of what's happening or what's the outlooks for 2023. So for the Canada, first and foremost, multiple fund managers believe that Canadian will outperform the US counterpart on the equity side. One of the reasons is low exposures to technology. So if you're looking at the TSX, the 236 stocks, our technology sector is extremely small. We probably have only a few handfuls of technology sectors that not representing 5% of the market. In fact, we have a strong exposure on the energy as well as the financial sectors. And this is where the part that you're looking at the high interest rate right now. The biggest beneficiary will be the bank, the insurance company. And Canadians have such a strong financial system and financial sectors that representing about 35% of the TSX. So that is a big tailwind for 2023 for the Canadian equity market. The second is with the energy prices sitting around $80, a lot of energy company are very comfortable of their earnings and paying out the dividends in Canadian markets. And this is something that is going to help dividend, of course, we all know, is going to help on protecting the downside of the volatility of the market. Last but not the least, the weakened US dollars. We expecting that, and we will talk about that in the next slide, is US dollar will be multiple fund manager will be expecting the US currency, it will be depreciated this year against not just Canadian, but multi-major currency around the world. We'll explain our view a little bit later. All in all, valuations, the PE ratio of Canadians is much cheaper than the US counterpart. We probably talk about 20% discount compared to the US counterpart. And if the same company, Canadian, is selling 20% cheaper, your upside potential will be higher. And this is how the view from the Canadian side. On the US side, a few things that concern our fund manager, first of all, is a heavy in technology sectors. If you look at S&P 500 and the Dow Jones this year, or last year performance, Dow was down by 8%. S&P was down by 50%, 20%. And the reason why the Dow and S&P go really different directions is the weighting of the underlying property to technology sectors. S&P technology sectors is around 25%. The Dow is only about 15, believe is less than 15%. You can see that the weighting or the swing of the technology sectors actually steer toward the market quite a bit. If you look at NASDAQ, is 50% is technology sectors. That's why last year it was down by 33% in the market as well. So the behavior of the technology sectors, especially when the market is turning or the economy is starting to go slow down or turning to recessions, those are the ones that tend to underperform. And US equity have such a big component in the technology sectors that actually will make the equity markets much more volatile. Second of all is the weakened US dollar, as we mentioned. Next slide will explain even more about why we think that this weakened US dollar coming this year. And last but not the least is also the valuation, the PE ratio. US dollars, US equity is tend to have around right now still looking around 16 to 17%, 16 to 17 forward PE ratios, where the Canadian or the international equity is much cheaper, much more attractive to buy the stocks. So overvalued. If you're looking at something we call the US dollar index, US dollar index is using the US currency, US dollar, against the major 6 currency around the world, which including Canadian, British pound, Euro dollars, Japanese yens, and a couple other Swiss country. So 6 of them, if you look at for the last 40 years, right now we're sitting at around 25% over premium, overvalue. And this happens back in 1980s. And that is probably the last time it happened. And few reasons why there are so many, the US dollar was so strong last year. First and foremost, if you're looking at the Federal Reserve rising the interest rate, US is the most aggressive central bank in the world that rising interest rate last year. Yesterday, we all hear that it's rising 25 basis points, but they're not probably planning to be much more aggressive than what we see in the last 10 times. But when the investor around the world, the global investor, they could invest somewhere that has a high interest rate, a secure country. And US was actually fit right into the bill last year. When the market volatile, they look at safe havens. And you're seeing the 3 months T-bill in US is yielding at 4%. Everyone's going there, and everyone buying US dollar go up. But this year, the time changed. If you're looking at the reports right now, or there's Euro, Bank of England, and also the European Bank, central banks, is start to rising interest rate more aggressive than North America this year. And you're going to start to see the money actually going the other way. So you're going to start to see the US dollar tend to go down quite a bit compared to the rest of the other major six currency. How about the international equities? International equities, the fund manager tend to overweight it. However, we have a fund looking at international equity. They overweighted in the bank and insurance sectors. This is the report coming from JP Morgan. JP Morgan's mentioned that we should be overweighted in interest rate sensitive equities in the euro, and also focus on the oil and gas equities. And what you're seeing that is, as Canada, which already have such a strong financial system and oil and gas infrastructures, we tend to like to invest to stay in Canada on these sectors. However, Asian market is part of the international equity, which is Japan. We tend to like Japan as well because we're going to be seeing that Japan will have a rising interest rate, which is going to help them on over appreciation of their currency as well, and as well as the equity market. Emerging markets is the last we're going to touch on. There's two potential tailwinds. Softened US dollars definitely going to help the emerging market big time, as well as the other one is easing of zero COVID-19 policy in China. Both of them, you're going to start seeing this. This is going to help the emerging markets to go back on track. And which if you're looking at the January market, probably the top performer is the emerging market for the month of January. So now we're going to use the last 5 minutes just to touch base of Canada Life model portfolio. As Clarke just mentioned, if you are the advisors like to use a managed solutions, one fund solutions, we have a full lineup of risk managed portfolio, asset allocation funds, as well as the ETF portfolio or the sustainable ESG portfolio for you. But for some advisors, say, no, Kelvin, I like to build my own models, my own portfolio. I want to mix the funds together. And this is where we can help you because we have 90 funds, over 90 fund selections in here. And my job is to help you to make your life, make your business much easier to manage. And by speaking that, basically we're taking to 5 different categories. Asset allocations. Every year we sit down with the head office investment management review team. We sit down with JP Morgan's, McKinsey, the head office global resource team, just to look at the outlook of the asset allocations before we make the recommendations. So by giving you the recommendations, the first layer is the asset allocations, how much is going to be in Canada, how much is going to be US, how much is going to be equity, how much is going to be in bonds. The next thing is we're going to be diversified through different investment managers. We're using multiple managers around the world just to give us the different perspective because no fund manager will able to make a right call every single time, every single day. From an equity and fixed income perspective, we're looking at the credit, we're looking at a stay in Canada or versus going outside of Canada. Last but not the least, if the clients are more aggressive, we're going to put into the emerging markets or the mid and small cap, or even if the clients or advisor would like to have the real estate funds, we're able to build in the recommendation with the real estate funds in there for you. So by all saying that, this is the models that it's going to be available nationally. Doesn't matter you're in Vancouver or you're in Halifax. If you talk to one of our regional sales manager, we're able to provide you what we call the core and explore models. That giving you an idea, this is a 5 funds models, 5 individual funds. We're going to help you saying that among the 90 funds, we shortlisted to bring it into a 5 funds model, depends on the client's risk tolerance. The reason why it's called core is because we're using a strong balance funds as the core. And if the client is more fixed income, more conservative, we add more fixed income. And for the clients is more aggressive, we can add more equities. And this is the information. If you do want to get further information about the structure of the funds or the recommendations, talk to the Canada Life regional sales manager in your region, and we definitely will be able to help you and provide you more. So by closing, just want to, once we set up this model, I want to make sure the model is doing right things for the clients, right thing for the advisors. So if you're looking at the 5 different models, by using a short-term view, last 3 years, it go with the market, with the down market in 2020 and then the down market in 2022. And looking at the models, if you look at the orange is the conservative, all the way to the blue is the aggressive. And you can see the volatility. We always bound by looking at just the rate of return, how the rate of return looks like. I love to have the highest rate of return. But when you're looking at the line here, it's showing you the investment experience. It's showing you that the ups and downs, and this is where your clients can handle the risk or not. So we're looking at short term, then the next thing is we're looking at long term. Just the 3 years is not enough. So 10 years, we're looking at it. Is my portfolio, my recommendations giving you the same experience, not just the short term, but also the long term? And in fact, in this case, we do. The higher the return, of course, it comes with the higher the volatility. If the clients are able to manage the risk, definitely, and you have the time. Last slide I want to share is not just compare our models to our model, but I also make sure that when I'm giving you the recommendations, we also compare to all the balanced funds out there in the market. In this case, the red one is our Canada Life balanced funds. And then the blue one is where the average balanced funds across Canada through Morningstar. And giving you just an idea is that beside the model is right for each individual, we also want to make sure that we are able to performing better than the peer group. So I know that my time is up. So I want to pass the stage back to Alex.
Great. Thank you, Kelvin. Kelvin, that was a great presentation on the services of Canada Life private wealth counselors. And of course, thank you to Clarke as well. So once again, on behalf of Graham, Allen, and myself, thank you for attending today. Thank you for the business. And once again, if you would like to engage one of the private wealth counselors at Canada Life, please reach out to Graham or myself. Enjoy the rest of your day. Thank you.